You've taken an interest in investing in the stock market. Now make sure you avoid these three common mistakes. We'll be looking at a popular stock, ticker RIDE, as our example. Okay, it's time for mistake number one. You've heard it a million times, buy low and sell high, but you must avoid the mistake of buying a stock that is in a downtrend. The reason stocks are in a downtrend is because smart, wealthy people that care about their money are not buying the stock. Thus, there is weak demand and too much supply of the shares, so price goes down until demand and supply of the shares are in equilibrium. Now, how do you define a downtrend? It is tough to spot when a stock is in transition from an uptrend or a sideways trend into a downtrend, but institutional selling of a stock is unmistakable because you can see the downtrend with any basic chart. The dead giveaway that a stock is in a downtrend is this moving average stack, which is this blue, this yellow, and this red moving average line. The blue is the 50, yellow is 150, and the red is the 200-day moving average. When the moving average stack all points downward, like it is in this whole period here, you have a stock in a downtrend. It's that easy. So if you're interested in a stock and you check the chart before you buy and see it's in a downtrend, you must take pause. Investigate further why this stock is being sold by large money institutions. Okay, now that brings us to mistake number two. So you make sure the stock you like is not in a downtrend and you put in your buy order. Let's say you buy right here. And a week later, the stock you just bought is down. You must avoid the mistake of holding on to a loser. All new investors make the mistake of not using stop loss orders. You should listen carefully to this explanation. Human nature is such that our ego wants us to be right. In fact, it needs us to be right, or else our ego is damaged. But the fact is, even the very best of professional traders are only right, that means picking a stock that goes up, roughly 50% or maybe at most even 60% of the time. That means 4 or 5 out of every 10 stocks the very best professionals buy will go down. The only way to keep the losers from overwhelming the winning stocks is to stop the losses when the losses are small. That doesn't mean cut every stock the second it goes down. So let's take a look at RIDE, a stock that I bought for a reason and where I got stopped out. So let's zoom in to this area in question. Okay, let's get a fresh screen. You can see this stock had a great setup, and I do mean a great setup. It's about as picture perfect as you can get. You had your tightness in price that gave us a great setup. You had your breakout signal, and I was right in here, right when I was supposed to be. But it did not go according to my plan. I was stopped out on day number 2 of this trade, when this stock went right through my stop. It hurt my ego to be wrong so quickly, but a hurt ego is better than a hurt wallet. And I avoided what turned out to be a major downtrend. Okay, now on to the third and perhaps most important mistake that new investors make, not looking at earnings of the stock they own. So the easiest way to check the financials is to go directly to the company's website. So we start at the home page and find the Investors Relations tab. And let's look at the latest quarterly earnings press release. New releases, this seems to be the latest one. Click on that. First thing we can see is this company lost about $95 million. This is not necessarily a good or bad thing, but we do need to examine this fact in context of the larger picture. So let's search for some context of the bigger picture and continue to scroll down. Here we finally have some numbers. So here we can see that this company had no revenues this quarter, no revenues the same quarter last year, no revenues year to date, and lastly, no revenues this time last year. So we have a company that has no top line revenue to derive profits from. So this investigation of earnings has revealed that this is a company that has no sales yet, which means this is a speculative issue. Which should alert the astute investor to the higher risk associated with a stock of this nature. Always respect risk. And remember, bulls make money, bears make money, pigs get slaughtered, and the wolves are out to eat you. Wall Street is a den of wolves, so be careful. For more tactics on protecting your capital, take a look at some of these other videos.